Welcome to the Deep Dive, your end-of-year briefing. And if you're like most of us, you've probably been watching the charts this week and just feeling this real sense of frustration.
Yeah, that grinding range.
Exactly. The market seems trapped, especially after that, high-profile rejection at $90,000. But we really need to look past that noise.
We do, because what's happening just beneath the surface is, well, it's a really profound and aggressive structural reinforcement.
So that surface action is basically a distraction.
A total distraction. We're calling this environment constructive tension. The consolidation you see on the charts is completely obscuring the fact that we've seen this aggressive escalation in corporate buying and, maybe more importantly, sovereign liquidity being pumped into the system.
And those moves are setting the stage for what could be a pretty dramatic start to the new year.
I think so. A very dramatic Q1 2026.
Okay, so our mission today is to really dissect that exact divergence for you. We're covering the reporting window of December 29th and 30th, 2025.
And we're going to focus on three core themes. First, the corporate Treasury supercycle, which is really industrializing now. Second, this idea of a sovereign liquidity put. And third, this fascinating split in the crypto economy towards privacy.
Let's unpack it. We have to start where the pain is, and that's the technicals.
Yeah.
I mean, the headline for the last 48 hours is that failed attempt to get back above $90,000.
A very significant psychological barrier.
And for a lot of traders, it turned into a very expensive bull trap.
It really was a classic price level rejection. It just confirmed that there's significant resistance overhead. If you just look at the raw 24-hour data, Bitcoin opened at around 87,258.
Right.
It pushed up a little to about 88,000, but then it closed weekly at 87,352.
That week close.
That week close is, it's a textbook bearish candle. It tells you that sellers were actively and successfully defending that territory.
But the big question is always who? Who is selling into that strength? Is this just, retail taking some profits off the table?
Not primarily, no. This was a much more coordinated distribution. We saw two very specific groups selling into that liquidity. First, the industrial miners, and second, what we call long-term holders, or LTHs.
Okay, so the big players.
The big players. They use that liquidity from the breakout attempt to offload inventory. They're covering their operational costs, their capex right before the fiscal year closes. They are systematic sellers, and they hit the bids hard.
So smart money taking the chance to, stabilize their balance sheets.
Exactly right. And that selling then triggers the second effect, which is in the derivatives market. When the price stalled near 90K, all those late leveraged long positions, they got liquidated.
A long squeeze.
Rapid long squeeze. And that just accelerated the move to the downside, confirming the rejection.
So that's the internal market pressure. But we also had institutional funds adding to the drag, what we're calling the institutional wet blanket.
Precisely. The price weakness got a whole lot worse because of continued outflows from the U.S. spot Bitcoin ETFs. The total was a net outflow of around $19.3 million.
And what really stood out to me was the activity in one of the biggest ones.
You're talking about BlackRock's IBIT.
Yeah. It usually sees these steady, consistent inflows, but it actually recorded a net withdrawal of $7.9 million.
That's a rare event.
It feels like a significant signal. Does that mean we're seeing a loss of confidence from those big institutional allocators?
I think it's important to look at the timing here. This is short-term pressure, and it's overwhelmingly driven by one thing: year-end tax loss harvesting.
Ah, right.
These institutions are booking losses on some holdings to offset capital gains they've made elsewhere in their portfolios. It's a purely mechanical pressure that sucks up buy-side liquidity. But it's a headwind that typically reverses and reverses hard in the first week of January.
It's the market digesting tax strategy, not a fundamental loss of conviction.
Exactly. Not a loss of conviction.
Okay, so while that short-term selling is noisy, let's pivot to what the long-term builders are doing. Because this corporate treasury trend, it feels like it's hitting a whole new level of maturity.
It is. We're seeing it evolve from, an idiosyncratic tactic used by one or two famous CEOs into a standard strategic imperative.
And what's really fascinating is how price-insensitive these new corporate buyers are.
Take Metaplanet Inc., the Japanese firm that's basically modeling itself after MicroStrategy. They just confirmed a massive Q4 acquisition.
What were the numbers?
They bought 4,279 Bitcoin for $451 million.
Yeah, let's break that down. The average purchase price on that is What, over $100,000?
It's roughly $105,400 per Bitcoin.
Wow. So they're buying significantly above the current spot price.
Which demonstrates extreme conviction. It signals they view anything sub 90,000 as just a temporary anomaly. They are willing to pay a substantial premium to secure the asset right now. Their total holdings are now over 35,000 BTC.
And the strategy here, specifically for a Japanese company, is huge.
Absolutely. They're executing a very sophisticated carry trade. We're calling them a yen sink. They're raising capital in Japanese yen, which is a very low-interest currency right now, and immediately converting it to buy a USD-denominated appreciating asset, Bitcoin.
So it's a direct hedge against the yen devaluing.
It's a deliberate hedge. And at the same time, it gives Japanese investors an equity vehicle to get Bitcoin exposure without dealing with direct custody. It's a brilliant arbitrage.
But I have to challenge that a little. Even with billions, are these companies really big enough to insulate Bitcoin from a major macro shock?
That's a fair point, but the power is in the precedent they set. They normalize the activity for everyone else, and then you see these strange market signals like the value inversion happening at Hyperscale Data.
Okay, tell us about that one.
It's a true financial anomaly. Hyperscale Data's Bitcoin Treasury, including cash they've committed to buy more, is now $76.1 million.
Okay.
Here's the catch. That $76 million exceeds 117% of the company's entire market cap.
Wait, run that by me again. So if I were to buy every single share of that company today, I'd spend less than $76 million to get $76 million of Bitcoin.
Exactly. The market is assigning a negative enterprise value to their core operating business, which is fully functional AI data centers.
So you're essentially buying Bitcoin at a discount and getting a whole data center business thrown in for free.
For less than free, actually. It is a classic screaming arbitrage signal. It tells you a sharp repricing event is coming, most likely in Q1, as funds step in to close that gap.
Now, shifting gears a bit to vertical integration. We're also seeing players try to lock down capacity, which is crucial post-halving. What's this move with Cango Inc. and Bitmain?
Right. So Cango Inc. just got a $10.5 million investment from a firm called EWCL, which is a known proxy for Bitmain.
And that investment gave them how much control?
It raised EWCL's voting power in Cango to 49.61%.
That is a whisper away from an outright majority takeover.
It's a soft takeover, and it's all about securing capacity. Bitmain, the biggest mining hardware maker, is using this public company to lock down valuable rack space and power. They're securing future hash rate for their clients.
And for Cango, it means they get first dibs on the new hardware.
Guaranteed priority access to next-gen rigs. It's a huge competitive advantage.
And before we leave the corporate side, we should touch on the concentration risk emerging in Ethereum with Bitmain Emergent Technologies.
This is a liquidity dynamic people really need to watch. Bitmain now holds a staggering 4.11 million ETH.
Which is what percentage of the total supply?
That's about 3.41% of the total supply. That level of concentration, especially since they're staking it, removes a huge amount of tradable liquidity from the market. And on top of that, they just declared a dividend.
A dividend on a crypto stock.
An annual dividend of 1 cent per share. So now you have a yield-bearing stock that tracks crypto exposure. It's an innovative way to package digital assets for more conservative, income-focused funds.
Okay, so the corporate buying is the microdriver. Let's zoom out to the macro forces. The Fed's recent activity, it looks less like tightening and more like deliberate shadow easing.
Yes. To connect this to systemic liquidity, you have to look at the Fed's standing repo facility. In the last few days, we saw usage spike dramatically. We're talking between $16 and $26 billion on certain days.
Okay, for listeners who might not track central banking minutia, what is the repo facility and why does a spike there matter for Bitcoin?
The repo facility is basically an emergency window where commercial banks can swap things like Treasury bonds for overnight cash from the Fed. It's a backstop. It should be quiet.
So it's being used heavily.
Seeing usage spike to $26 billion means the Fed is aggressively stepping in behind the scenes to make sure the financial plumbing doesn't freeze up.
So instead of a big press conference about cutting rates, they're just quietly injecting liquidity.
That's exactly why we call it shadow greasing, or a sovereign liquidity put. The Fed is signaling, with actions not words, that they will put a hard floor under systemic liquidity, and that liquidity has to flow somewhere.
And it flows into scarce assets like Bitcoin.
Providing a very robust tailwind.
And that liquidity isn't just chasing scarcity. Sophisticated investors are also positioning for something else. More government surveillance. This surveillance premium thesis seems to be driving big moves.
It is. Look at Cypherpunk Holdings. They just made an aggressive pivot, buying $29 million worth of Zcash, or ZEC.
And that brings their total ownership to what?
Meaning, as global regulatory surveillance tightens, the financial premium for actual on-chain secrecy for assets that can resist chain analysis is going to skyrocket. They believe Zcash's privacy features will become incredibly valuable.
Speaking of innovative strategies, let's talk about Grant Cardone's plan to bridge old world and new world assets, this real estate Bitcoin IPO.
This is truly innovative. It could be a key to unlocking trillions in traditional capital. Cardone plans to launch a publicly traded company that holds both real estate and Bitcoin.
And the model is?
It's simple. You use the consistent fiat cash flow, the rental income and tax benefits from a massive portfolio of multifamily properties to just systematically perpetually buy Bitcoin.
So the tenants paying rent are effectively funding the company's Bitcoin acquisitions.
Precisely. They've set a target to accumulate 3,000 BTC by the end of 2026. By combining the predictable cash flow of real estate with the deflationary scarcity of Bitcoin, he's creating what he calls a perpetual accumulation machine.
So while all this big money is reinforcing the space, we do have to acknowledge the friction points, the regulatory roadblocks and security risks that are slowing things down.
And for that, we look to South Korea. It's a top 3 global market, but the regulatory friction there is palpable. Their stablecoin bill has officially stalled.
Why? What's the holdup?
It's a legislative tug-of-war over who gets to issue stablecoins. Should it only be established banks, or should fintech companies be allowed to compete? This delay keeps the famous kimchi premium volatile.
Right, because they don't have a reliable local on-ramp.
Exactly. They have to rely on offshore assets, which keeps their market inefficient.
We also saw a much more serious case emerge from South Korea, one involving espionage.
Indeed. A South Korean crypto exchange executive was just sentenced to 4 years in prison. He took $487,000 in Bitcoin from North Korean agents.
In exchange for what?
In exchange for stealing state secrets, mostly military and tech data.
That's a chilling precedent. What does that case formalize?
It formally establishes Bitcoin as the preferred payment rail for modern espionage. It's traceable, yes, but it's also borderless and censorship-resistant. This will absolutely accelerate government scrutiny and vetting for crypto executives.
And finally, a cautionary tale for every retail user out there about basic security, the Debo incident.
A really significant data leak. It happened during a server migration at Debo, which is an AI trading tool. It led to user private keys being compromised.
And the losses.
At least $250,000 confirmed so far. And while the company says they'll reimburse everyone, it just reinforces that fundamental rule. Not your keys, not your coins.
If a third-party service holds your keys, you have counterparty risk, period.
No matter how advanced the tool is, you've introduced a central point of failure.
So as we wrap up, it seems we're being shaped by two huge opposing forces. You have this aggressive, smart money accumulation happening underneath.
Driven by corporations and macro forces.
Versus this temporary technical and tax-related selling pressure pushing down from above. The gap between the price and the fundamental adoption, it rarely gets this wide.
And the final synthesis for you should be this. The big institutional players, they see this consolidation under $90,000 not as weakness, but as a final accumulation window. The supply crisis being driven by price-insensitive buyers like Metaplanet is not theoretical. That supply is being pulled off the market, and that shock feels inevitable in Q1 2026.
And to leave you with a final thought, one that connects this digital scarcity idea to the traditional world. Elon Musk recently tweeted about China's coming silver export restrictions. He just said the logistical constraints are not good.
And that fragility in hard assets, where tariffs or export controls can just choke off supply and spike prices, it only reinforces the value of digital scarcity.
Bitcoin is the ultimate unencumbered asset. You can't put a tariff on it. You can't stop it at a border.
Something to seriously consider as you compare hard assets heading into the new year.